Hi guys, thank you so much for tuning in to Moneycontrol Market Weekly. I'm Karunya Rao, and as always, I'm back for a weekly wrap and to understand which ways the market's headed and what should retail investors make of it. Joining me today is Mr. Ajay Srivastava from Dimensions Consulting. Mr. Srivastava, it's always a pleasure to have you on board. Thank you so much for joining in.
Thank you very much. I think it's a very interesting 72 hours which have pivoted the market from the highs to the lows. It's a very bruised investor base which is going to go back in the weekend, I guess, after the highs of Tuesday. Absolutely unprecedented what happened in the last 72 hours.
Right, but as a retail investor, should I be worried about what's going on in the markets, the bear grip, especially on the broader end of the markets?
You should be worried because the only reason is that lots of the mid-cap stocks are running at P's which are just unsustainable. So we must remember what happened in the last 6 months. It is basically P expansion and hoping that there will be a big recovery in sales volume, which is not going to happen. And unexpectedly, and people ignored the issues of oil prices, inflation, and commodities, and so on. So a broad sector of mid-market was running at a P's of 30s and 40s and above. And Karuna, if you remember, these are the companies which typically go in a mid double digits or even below double digit P. So I think what happened in the last 72 hours is that P compression is now coming into the fray, and the retail public needs to be well aware because a lot of them are over invested in this sector. So yes, you need to be concerned because P expansion compression is now on the way. Market always overreacts on both sides, positively and negatively. So to that extent, but I think we will see now, at least for a set of companies like chemical companies, etc., the PE compression and realization will be here to stay.
So will the volatility then, is it?
Well, it's not volatility because it's a one-way street. If you look at 72 hours, there'll be no recovery in the market. It's been like a straight slide down every day. It starts off a little better, and as the day goes past, people start to sell. So I think there is substantial maybe deleveraging happening, maybe a substantial lightening of the position happening. Maybe people are booking profits, but I don't think it's volatility. I think it's a one-way street, and we should remember that the whole Indian rally in the last 3 weeks or 4 weeks was a domestic rally. There's no FII participation in this. So that's why you'll see now more domestic pain than FII pain in what has transpired in the last 72 hours. So I would not say volatility. I'll say I think market is lightening up the holdings in mid cap and small cap.
Okay. One very clear-cut trend and one of the most prominent trends has been the outperformance that banks have been able to stage. And, at least our analysts at Moneycontrol Pro were very optimistic about banks. And they said, in fact, if there were, more legs to the rally, it's going to be banks which will lead that. Do you concur? Do you think the kind of buoyancy that we've suddenly seen in banking space, especially PSU banks, is it here to stay?
See, banking was a last resort because banking did not participate in the rally for the last 2 months or so. So therefore, you said, okay, now the banks will come and participate. You saw the absolutely insipid performance of HDFC Bank, by and large, which tells you what the industry is looking like. Nationalized banks, I have always maintained, are a pure trading play and a play with people saying that now they're having sold Air India, most likely they might have to sell a few banks. And that is what is driving the investment thesis on the nationalized banks. On the portfolio front, growth front, nationalized banks have no thesis. There's no growth in revenues. There is no growth in asset books. Their mudra loans are all going to go into a write-off. Let's be clear about it. All the restructured MSME loans are going to end up in second restructuring and write-off. So to my mind, nationalized banks fit the model that they have much more write-offs coming in the next 12 to 18 months as mudra loans, restructured loans start to become due for payment. They're not becoming due right now, so you can live with it. But the thesis of investment is only one. Will the government disinvest one or two of the large banks in the next 12 months? If that happens, I think it's a good investment to keep for 1.5 years. But if you're investing for fundamental, I don't think so it's going to be there. On the banking sector per se, given the competition from fintechs, the demand volume, economy is growing at 5-6%. So let's be honest. So there is no demand coming into the system. Companies are deleveraging. individuals now, when they see the pain coming in the market, they are borrowing hand and foot, but I don't know how long will it continue. So on the demand side, the banks have a problem. On the supply side, money, there is abundant FDs, so I don't think there's a problem. But I think so that they have a problem of revenue generation and revenue growth. And HDFC Bank result shows very clearly. There is one big event which will happen now in the next 2 weeks is the sale of City franchise. I think whichever bank wins it, that is going to be one big whopper of a upside, whether it's HDFC Bank or a Kotak or who wins it. I think there will be a big up for that bank at least when the sale is announced. So I think that's a one big trigger. But domestically, otherwise, I don't see any big trigger for the banking industry.
Last time when we spoke back in May, you were fairly clear that PSBs are not, your top bets, or not even top bets, but you had a clear avoid stance on it. So that stays. And the banks that you just mentioned, the private lenders, are something that you would be watching out for, is it?
Yes, because I think the only thesis to invest is a good quality private bank. Eventually, India will have to grow at a 7+7-8% growth. Some growth will come back, but that could be a year from now or 2 years from now. But for portfolio managers and for investors, the key is return on capital, because you got limited amount of money, so you got to make what the best the market offers at a point of time. Theoretically, you should buy HDFC Bank. It's been a good return generator for millions of Indians for a long period, but not been so for the last 1 year. So if you have a very long perspective, sure, private banks will make money and do what is required to be done. But whether they'll outperform the market, my guess is no. And the reason is only one: the competition from fintech. That's changing the dynamics globally. It will change the dynamics in India. Indian banks are far behind in technology, and therefore they either have to spend a lot of money or buy a lot of expensive fintechs to be in the game. And that's why I say that in a longer term perspective, maybe the banking sector may not give the same returns as you saw in the last decade or so.
Okay, all right. Help us understand what's happening in the metal space, because even that has significantly corrected this week, and there is a lot of still uncertainty as to where this is headed.
See, metal space, I think, is the best space to be, if you ask me, among all the sectors, for the simple reason that actually the valuations are pretty reasonable, even at the highest level of steel companies. We're talking of not even P's of 10 at this point of time. And with the deleveraging going on, the nature of the company will change. So yes, the prices may go up and down. Steel industry will do good in some months, may not do in some months. Coke prices may go up, but eventually the structure of the industry has changed substantially, and that's why the valuation will change grudgingly, slowly, but acceptedly. And the corrections are also, if you notice it, Karuna, not very great corrections. Hindalco will go to 530, 540, come back to 480, then 470, then travel back. So will the steel company. The sale will hover on 120, not anymore in 40s. JSW Steel will run around in 650s and above, kind of a bracket. So you will see that now a new high is gradually, a new base is being formed for steel companies. Deleveraged steel companies will behave like cement companies. 6 years back, cement companies were down in the dumps, the valuation was low. Post consolidation, deleveraging, you've seen how cement has been revived and how the valuation has changed. Steel is at the cusp of it, and I think you will see that this will perhaps sector, steel and commodities, will for India offer the best return for investors, even though they have been relatively volatile. And the best part, dividends. Some of the commodity players like Vedanta, the dividends flow has been very good in this Zinc, etc. So you'll find good money coming back, as well as the fact that this will be a best return for the segment for the next 2 years.
Any other, attractive or favorite picks that you have at this juncture in terms of sectors? Because at a time when things are, if not meaningfully correcting, but things are at least lower than their, significantly lower than in their recent highs, which stocks can investors look at?
I think one of the sectors is definitely we have investments, so for disclosure purposes, is soda ash. I think that's one commodity which has globally hit the highest peak in the last 1 month or so of the prices. There is a shortage of soda ash in the market. So I think the companies in India which are in the business, the 2 or 3 large companies, they will reap, I think, enormous tons of profit on them. One of the companies obviously restructuring itself, so that restructuring benefit will come to that. So there's a soda ash story going. There is a consumer durable story going on where there has been an acquisition by a private equity player of a large companies, which will get into a separate listed company. So you can get it early in that listed company. So consumer durables with the private equity, soda ash companies, I think is going to do very well. And the last point is export companies on the homemade and home textiles. I think they are going to do tremendously well. Their results will be astounding because the export market is booming. So those companies, there are 3 or 4 companies only, not very large, I think will make a hell of a lot of profits compared to market expectations. So if you run across these companies, I think you are doing a pretty decent portfolio. Some are restructuring cases, some are basic commodity cases, but at the cusp of very high profitability.
Okay. All right. So, what about the earnings so far? What do you make of it? Because right now we've had a significant chunk of FMCG companies deliver their earnings. Some cement players have also given out their report card for the quarter gone by. Banks, last week we had HDFC, tomorrow we have ICI, and today we have Reliance as well. So, how are you sort of reading into the numbers that have trickled in so far? Are you happy with the performance?
I'm happy because I think they have done better than what I thought. Maybe market expected a lot more. That could be one disappointment because this was not supposed to be a great quarter in any case because of monsoons, the industrial activity drops, construction drops. So I don't know. From our perspective, results are decent. Except the problem, Karuna, is that the P ratios are running ahead of everybody, and that's what we started discussion with. Even after they did well in relative terms, the kind of valuation they were commanding or the stocks are commanding is a problem. So you have a few outliers. Like we saw, I don't have a holding, but we saw the result of TVS Motor yesterday. Absolutely stellar results. Some of the companies which are market favorites are doing very well. Results are very well. Things like Energy Exchange, which will continue to prosper. So you don't have to worry about a quarter result or a quarter performance. So those will do well. But broadly speaking, consumer companies, I think so far Hindustan Lever is the largest one come, disappointing result. Chemical companies have been disappointing. Auto companies have been kind of lukewarm at this point of time. So I think you'll see a slew of lukewarm results, but some of them will be pretty stellar results at this point of time. And TVS has shown us an example as to what a stellar company can do. The stock has done well, etc. But I think as you go forward, one will see disappointing results from the paint sector. That is definitely going to disappoint everybody. One will see disappointing from FMCG sector. But I think you will see I think JSW results came out yesterday were pretty good result if you ask me. Thanks to market, it didn't move, but results are pretty good. So I think steel will still give good results, commodities good results, but consumption sectors are, I think, heading for a problem because that's where the demand is still not picking up. We are in the middle of festive season, early festive season, but Karuna, whatever we are getting to know from companies, the demand has still not come through to the market compared to 19. So consumer durables, consumer products, I think, are heading for a little rough ride.
Right. But a big theme apart from commodities and what's happening with respect to raw material prices is also the logistics and the supply chain issue, which has hurted companies across the world, and everybody is talking about it the world over. And even when it comes to the commentary, a lot of people have sort of talked about it, how supply chain issues have slowed down the pace of the recovery or pace of the performance. Just to help our viewers understand, can you put things in perspective for them? How how supply chain issues can actually dampen the overall sentiment, not just demand, not just supply, but the overall sentiment in the market as well?
Well, it's quite simple. Without underestimating the problem, it's much more acute in the US and Europe than it is in India at this point of time. That's one. The biggest, of course, is the car companies have been affected very badly because not only supply chain, but because the chip issue, everybody knows about it. But otherwise, we have seen some disruption in Indian companies when we talk to them. We have not seen any major disruption coming. There have been delays. There have been cost increases because the freight cost from China to India has gone up by exactly 4 times over the last 6 months. That's roughly the increase. That's what is hurting. Availability of containers is still pretty okay. So we have not seen, Karna, any major company saying that we have a supply chain has caused us the problem in terms of production and the demand is there, except the car companies, leave them aside. So Yes, it can dampen, but I think Indian impact, because we are a kind of a domestic company where a lot of people work whole domestically, raw materials are domestic, everything is domestic. It's not been so bad compared to the other parts of the world, which are primarily dependent on imports. And well aware that with the thanks to tariff increases, lots of substitution has happened in the country. So people are working with Indian, including car companies and auto companies. So India has relatively, left me unscathed, if I'm not wrong, from the response I see from most companies.
Okay. So if one were to ask you, Mr. Srivastava, I have about 1-2 lakh rupees worth of corpus. Should I start picking stocks right now, given that markets have come off their recent highs? What would be your advice? Is it a good time to enter? Is there ever a good time to enter?
There is always a good time to enter, but the key is when you exit. I think that's also very important, that you need to frame your exit kind of guidelines to yourself very clearly, which means that if a sector goes bad, you need to bail out and not carry the whole can down to zero. I think that's more important to me. For smaller investors, I keep saying that you pick and choose your stock and keep adding up, because one, you cannot time the market. I cannot tell you whether the stock is going to be cheaper. I must be God, to do that, and I'm not, and I don't think anybody is. So I think it's prudent for a small investor to say, I need to, first of all, 1-2 lakh people. My view should never be in the equity market; should be in the mutual fund market, diversified risk. If your one company goes down and your 1-2 lakh is that one, and 2 lakh, will get you only one company by and large. Your portfolio could get wiped out in a 30 seconds. So if you're a smaller investor, my telling them is stick to mutual fund, stick to safety more than returns. Because if you make 20-25% return, be very happy with it, because that's a return with Warren Buffett, with all his wisdom, made over 20 years. So so I think that's a simple advice. Go to mutual fund, buy when you feel like. Certain sectors you never want to buy, like for instance, I would not like to buy automobiles at this point of time because they're struggling. FMCG, as I said, I would prefer, if you have 1-2 lakhs, start with commodities if you don't have, because that's one sector which will give you steady returns.
Right. Okay. Any of these, upcoming IPOs that you like or you find interesting?
You know what? I think IPOs in India, I'm sorry to use the word, is becoming like a almost quote unquote a word, a scam, because the biggest money has been taken by private equity investors. The valuation they are coming up with, crazy, absolutely. It's maybe there is a one odd company which has done well, but more in the IPOs which are coming, which are the e-commerce companies, the valuation is nutty, absolutely. So I would not be a better on these companies, the e-commerce companies coming to the market at these valuations, unless there is a dramatic fall in what the price they come to the market. And I think investors should know that the real juice has been taken by the early investors, the P investors. What you're coming to invest is not going to give you any great shakes return. So unless, as I say, the IPO that we see listed in the market, lots of them are new gig economy stock coming, but at valuations which I will not even advise myself or anyone to buy, even in dreams. So and I think what happened in the market in the last 72 hours should bring some realization in the IPO market also, that you got to be realistic at what you're pricing. And we have seen already that you've seen more than almost 60% of the IPOs come in the last 4 months are now underwater at this point of time. So IPO game was good till it lasted. The banks have got greedy, valuations have gone stupid, and therefore I think for an investor, buy in a regular company and let these companies come. Whoever wants to take out the PE fund, let them take it out. You shouldn't be the one giving the money to them for them to have the moolah while you sit with the losses.
So none of these models or none of these consumer tech companies excite you, even from a business model standpoint. Forget if we leave aside the valuations. Of course, it's tough to ignore valuations, but
No, there
purely
is no.
on a business model.
Karuna, business model wise, I have no argument that you have to ultimately go invest in the gig economy, right? Because that's the way the new world is working. You buy online and so on and so forth. But there are limits to what you want to pay as an investor to these companies at this point of time. And that's that they're not competing. They're also got a competition. It's not that Nykaa doesn't have a competition. Nykaa has a competition. Amazon and MyGlam and everybody, etc. So the question is, it's not like these companies are not like the US companies which really went into monopolies like a Google or this thing. But look at the valuation of these companies they're asking us to pay. It is something which is 10 times of what I would pay for any US company at this point of time. Sure, there is an Indian market, there is a new impact, So I'm not paying those kind of valuations because the market growth that they can get out and compete with each other will be X amount of it. And we have seen that now, and the pattern that the growth pattern of these companies, they're growing very well, but now there's a little bit of plateau which is coming around. And as I read, as I understand, one of the big IPOs has an issue in terms of replacement. News may be right or wrong, I do not know, but logically it should be, because Indian rally for last 60 days is done by Indian investors, not by FIs are not buying into this pricing and valuation. And I think that's a good indication that if we are buying, global fund managers not buying, there must be a real reason why we should be there in the first place. This correction has brought some sanity. I hope IPO and the new gig economy stocks also come with some sanity.
Mr. Srivastava, if we talk about your portfolio, how is that positioned right now? Because I think at the start of the year or around March or so, you were devoid of banking stocks. Now that your view has also slightly changed towards banking and financial, has there been any change?
I had zero in the month of March portfolio allocation to banking, which is unprecedented. It's never happened in my whole career of years, decades. I've never happened, but it was zero. It is still zero at this point of time. And because the real world stocks in India, I think will give a much better return. Financial stocks are not going to give the best return. Karuna, the thesis is simple. The economy is not growing at 10% or 9% or 7%, right? Companies that are capital investment is not happening at 37% of the GDP. It's happening at 26, 27%. Every company, I'm sure you are talking to a lot of companies, wants to pay off the loans and say, listen, I don't want to get in the loans. And one of the reasons is that, the default in India, unfortunately, has come with so many of, let's put it this way, penalties, which are personal driven. You could become a defaulter, you may not be able to leave the country, you could, whatever happens to you is separate. And there's a very thin line between, what's been a commercial disaster or a problem area versus you've taken away money personally. So by and large, the leverage environment in this country is now got restricted to very good quality companies at this point of time. And people are scared to borrow. That's the honest answer. People are rather saying, good equity is available, take the equity and don't borrow. So in that scenario, the banks have a very limited role to play. And on the consumer side, where the banks had a monopoly because of RBI was not licensing any new banks. Remember this, in last 10 years, when banks made the best return, there were only 2 licenses issued for banks, only 2. In the last 5 years or 3 years, now you got at least 40 fintechs and 6 or maybe 10 new banks which have got licenses. So, to extrapolate and say they made super normal returns. They made returns because RBI created a monopoly. Now that bank monopoly is gone. And therefore, the banks are in a new era. And that's why you find people like HDFC Bank now struggling for traction and volume because they are used to a monopoly. They are the old Bombay Club. If you remember the term called Bombay Club, that was the true Bombay Club of India, the 7 banks making all the money. Now the competition is there, and you see what's happening to them as the banks are really struggling to give. No, I saw HDFC Bank, it got 5% growth rate. Can you believe it?
Yeah.
They always used to talk about 2 times the country growth rate at the Tripuri's time, but now they are at 5%, which tells you that competition is really hurting.
What about pharma? Have you lapped up on pharma in the last few months?
Well, I have pharma stocks. I have hospital stocks more than pharma stocks, to be honest.
Okay.
I have only 2 pharma stocks, which are all 100%, almost 100% export-driven companies, by and large, in advanced products. So that's my pharma portfolio. I think pharma will do well. Eventually, they will do well, but they will go through their own gyrations in the next 1 or 2 years of cost compression, which is taking place, cost increases taking place, and margin compression that we see all around. So pharma is a sector, Karuna, one has to understand you have to invest for 5 years to get return in 2 years. It never gives you return year on year like most top sectors. So if the returns were fantastic, absolutely in the last 2 years, I think we'll have to now wait for the next cycle for the returns to come. So we are invested, but most of our stocks is either diagnostics or hospital. Pharma is a little bit of it. And even some of the stock valuations are crazy, like Cram's company valuations, 40 times EBITDA, 30 times EBITDA. Growth is not even double digits. EBITDA is 30 times. Now, I don't know. Some mathematician should tell me why should I buy those companies.
Okay, Mr. Srivastava, before we let you go, just one thing real quick. What would be you keeping a watch on? over the next few weeks when it comes to the equity markets, and what should retail investor do? Be also watching out for.
I think three things, not one thing, but three things. One is we need to see the good sign that FIs have to come back to the market. I think that should be a wonderful sign for the market to kind of move to a new direction, because you just can't run it on local investors. So FI investment coming is, I think, a great thing to happen. The second important thing is what the government is going to do with this oil. Because whether we like it or not, if I'm going to pay, or any normal consumer has to pay 110 rupees for his petrol consumption and pay for his school bus and this thing, the discretionary expenditure he has to spend goes down. It's quite logical, right? And therefore, if this unbridled expansion continues, I think we'll have a serious problem in terms of consumer demand, whether in short term or long term. So that's one is FI investment. Second is the petrol prices. And the third is how prudent are the investment banks that the next 4 or 5 IPOs which come to the market have a little more successful run compared to the otherwise like Glenmarks, etc., which kind of ruined this market at this point of time. So I think three things. We must have successful IPOs giving good returns. We must have government something to do with the petrol, because consumption expenditure will not rise otherwise, and FIs need to come back to the market in a little bigger way for the market to show trajectory that we are now globally in the range where valuation makes sense.
Absolutely. Some very critical monitorables to watch out for. Mr. Srivastava, it's always great to have you on board and
Thank
get
you.
perspective from you across the board. Thank you so much for joining in. And
Thank
have a
you.
great
You have a wonderful weekend.